Hello everyone, welcome to QuantSoc. Thank you for coming today. My name is Paris. I'm going to be taking you through a little seminar on state prices. If you don't understand too much, that's okay. This is like postgraduate level stuff, so I'll try to walk you through. If you have any questions, please do ask. Let me first take you on a very quick recap of what we did 2 seminars ago. Does everyone remember this stuff if you attended? No? Okay, so basically there's this thing called the binomial model. By the way, is anyone on the Discord? Yeah, a few people? Okay, if you want to join our Discord, you can probably find slides on there from previous things. If you want to look through those for some more information on what they are.
Might is Victor all right? Because I heard stories about him on the Discord.
What?
Is Victor all right? That might because I heard stories about him on the Discord.
Is he all right?
Yeah.
Yeah.
Because I heard he's been sleeping on the highway, which makes no sense.
He's been sleeping what?
On the highway.
What? I don't know. Anyway, okay, so basically over here. So we introduced these 2 probabilities. They're not actual probabilities, but they're called risk-neutral probabilities. Okay, we put a tilde on top to represent the risk-neutral probabilities. So the basic model here is that we have a stock price, an initial stock price, S0, and what can happen is either the stock price goes up or it goes down. Okay. If it goes up, it changes by a factor of U, or an up factor. So it becomes S1, and we say H for heads, and then it becomes an up factor of S0. Okay, so it goes up. Then the other thing that can happen is that we get a tails, which essentially represents it going down. Okay, so it goes down by a factor of S0. Okay, now the probabilities P and Q represent the probability, the actual probability that this stock S0 goes up or down. Okay, so P is up and Q is down. And then we introduce these risk-neutral things, which are basically they're kind of a probability because it still satisfies the equation P tilde equals 1 minus Q tilde, so they sum to 1, but they're not the actual probabilities. Okay, they're just yes.
Sorry, it's too silly questions. I've been wondering it for a while, but how do you determine P and Q? Is it based on past data?
This P and Q.
Yeah.
The risk neutral.
Wait, sorry, not that. Sorry, I mean up and down actually.
The up and down. It's just depends on the stock.
So it's always on past data. There's no way you can forecast if it's a newly launched stock.
In practice, it would be on past data, but these are just like models that we're just sort of hooking up without any data. They're just like, oh yeah, let's pretend that all these things hold in place. Okay. So these P and Q, if you look at the first set of slides, if you join the Discord, I'll get Victor to get the link up when he comes back. Basically, it's such that S0 equals this thing here. Okay, so 1 over 1 plus R times all of P tilde multiplied by S1H plus Q tilde S1 of T. Okay, and the reason we do this is because they just sort of appear out of thin air because they help us calculate some stuff back then. Okay, so if you want to have a look at the slides there, that's what these P tilde and Q tilde are. We call them risk-neutral probabilities because they're like probabilities. They're not the actual P and Q of the stock going up or down, but we're going to be using them. Okay, if you play around with the numbers, you will get that P tilde is actually equal to this thing here, 1 plus R minus D divided by U minus D. Q tilde is equal to that thing there. Then we have these 2 probability measures. Okay, so we put a tilde on top of the probability measure to represent it being risk neutral. Then we can also have the expectation being either actual or risk neutral, where we either take the expectation with respect to the actual probability measure or with respect to the risk neutral one, where we put a tilde. Okay, does that make sense so far? Just assuming that all of this is true. Yeah? Okay. Oh, sorry. Sorry. R is like it's a interest rate. Okay, so sorry, I didn't explain that. The way we replicate the option is basically we trade a combination of stocks and bonds. Okay, so stocks are just our ownerships in businesses, bonds are like loans, and then we have an interest rate associated with the loan. Okay, I'm not going to go over too much of that because they're in the slides. Yeah, you can have a look at those if you want some more info, but U is the factor up, D is the factor down, and R is an interest rate. Okay, does that make sense? Okay. So that's sort of the background information here. These are some formulas that we're just going to assume are true. They're in like a second set of slides that I don't think we've released, but just assume that these things are true. This big Fn thing here is just like information up until n. Okay, so this thing is information up until n. So it's like saying you're maybe like at a casino and you're playing some gambling game, and then you have all the information up until time n. Okay, so that makes sense. It's just information. Yeah? No? Yes, okay. So we're going to be going through 3 things today. The first one is a change of measure. So as we said here, there are these 2 measures, actual and risk neutral. Sometimes we're dealing with the risk neutral measure and then we want to change back to the actual measure. Okay, so we're going to find a technique to do that. We're also going to introduce something called a radon-Nikodym derivative process. And then we're going to talk about optimization in the capital asset pricing model. Okay, so change of measure. In the binomial no arbitrage pricing model, what does no arbitrage mean?
Oh, yeah, sorry. I was going to ask a question about that.
Yeah, go on.
That means essentially you haven't put any of your funds in yet, right? Like, essentially you're trying to make a gain without putting any of the funds in.
Yeah, that's true. So arbitrage is basically this thing where you can make money out of nothing. Okay, so for example, say there's 2 people and they're both buying and selling apples. One of them is buying apples for $1 and the other one is selling them for 50 cents, right? So it makes sense in this hypothetical world that you can go to the guy selling it for 50 cents, buy like 4 of them for $2 in total, and then you go to the other guy selling them for $1 each, and you just make free money. Okay, that's called arbitrage. The assumption that we sort of proved in the previous, when 2 slides ago, was that if we trade with a combination of stocks and bonds, when there's no arbitrage, it becomes the fair price of the option. And that's how we like price the option. Okay. I'm sorry, there's a lot of background information that is packed in here. Yes.
What's the industry standard for calculating fair price? Do you use mean reversion or a rolling mean over 30-day period, or?
I don't know.
Because I asked it's called, and they just said you need to calculate the right fair price. And I'm like, well,
yeah. Yeah, I mean, like a lot of the time we just use models. It's just like, they're not, we don't have all the answers, It's our predictions are as good as our models, right? So there are 2 probability measures. One is the actual probability measure, and that's like the empirical estimation of the model. The other is the risk neutral probability measure, which is under the discounted prices of assets. Okay, and they're going to be martingales, which is basically that result over there. That just means that, I'm gonna ask a question there. Martingale is basically when the expectation of the thing with n plus 1 given information up to n is equal to the thing with the subscript n. So that's just, okay, let me do it over here. This is what a martingale is. So it's basically like, given information up to time n at a casino, my best guess for what's going to happen next, n plus 1, is what happened before. Does that make sense? Does everyone know what expectation is? No? Okay. This is what an expectation is. It's a weighted average of the probability and the value of the random variable. Okay? So it's that thing there. A martingale is just a fancy term for this thing. Okay? So the information up to n is just going to be value of n. Hello? Is it locked? I don't know. Okay. So these two probability measures give different weights to the asset price paths in the model. They agree on the price paths which are possible, but they disagree on what these probabilities are. Okay, so P is not the same as P tilde, nor is Q the same as Q tilde. Okay, the actual probabilities are the right ones. The risk neutral probabilities are just the fictions that help us construct, that are a helpful construct because they allow us to solve these equations. Okay. So more generally, we're going to consider a finite sample space omega, which is just like a collection of things that could occur in a probability space. Then we have these two measures, P and P tilde, P and P. So P again is the actual probability measure, P tilde is the risk neutral probability measure, and then we're going to form the quotient Z equals P tilde divided by P. Okay. And then because this Z depends on the outcome of a random experiment, it's a random variable. Okay. We also call it the radon-nicotin derivative of P tilde with respect to P. Okay. The name we call it. Although in this context of a finite sample space omega, it's really a quotient rather than a derivative. The random variable Z has three important properties, and we will state this as a theorem. Okay. So let P and P tilde be two probability measures on a finite sample space omega. Assume that probability is positive for every omega inside the big omega, and define the random variable Z by that quotient there, which we talked about before. Then these three properties hold. Okay. We're not going to prove this, but if you want the proof, it's in a textbook called Shreve's Stochastic Calculus for Finance number 1. So we're just going to assume that these things hold. Okay. This tilde should be on top of the E. So basically the point of this is that you can sort of change the measure. Okay. So if we're working in if we're working in the E measure, or if we're working in the E tilde measure, we can flip it to the E measure by changing stuff and introducing this Z. Okay, so we've just sort of popped this Z out of thin air. Okay, we've just said, okay, look, we're going to divide the risk neutral measure by the actual measure, and then if you have E tilde of Y, you can let that equal to E of ZY. Okay. So this is just a way to flip the measures. Okay, you can change the measure. Does that make sense? Without the proof. Make sense? Yeah? Okay. So here's an example of a particular 3-period model. So again, if you have U equals 2 and D equals a half, which basically means that it's either going to go up or down, is something that could happen up to time 3. Okay, so we start off with the initial price being 4, and then if we flip a heads, it'll go up to 8. If we flip a tails, it'll go down to 2. Then we perform the experiment again. We can either double, or we can half, or the lower one could double. Okay, and so on and so forth, depending on whether it's a heads or a tails. So we'll consider 3-period model that we just saw before. The underlying probability space is this thing here. So this is just like the possible things that can occur. Okay, so if we flip a coin 3 times, here's the things that could happen. Could be 3 heads, could be 2 heads and a tails, could be a heads, a tails, and a heads, and so on and so forth. Okay, that's what the big omega is. A big omega is just the things that could happen. Okay, so we're going to assume that the probability P, the actual probability measure, so this one here, is going to be 2/3, and the Q is going to be 1/3. Okay, and the actual probability measure is this thing here. Okay, so 3 heads is going to be, since this is the probability of the heads, we just multiply this, we cube this thing. Okay, does that make sense? So to get this, we cube it. To get this, we have 2/3, because it's a head, times 2/3 times 1/3, which is 4/27, and so on and so forth. Okay, this makes sense how we get to this. Yeah. Now we take the interest rate to be R equals 1/4, a quarter. And then the risk neutral probability of head is going to be a half. So the Q is also going to be a half. And then the risk neutral probability measure is this thing here. Okay, all of them are just an eighth because you just flip a coin 3 times and they're all a half. Okay. Hello? So therefore, the rate on Nicodem derivative of P. So what was the Z again? Yeah. Yeah. P tilde was P tilde over P. Yeah. So essentially what we do here is we just take whatever the P tilde was. So P tilde for HHH is 1/8. Then we divide that by the P, which is 8/27. Then what is this thing equal to? Well, it's going to be equal to 27/64 in this case. Okay. And then we do this for all of them. Okay. Does that make sense? How we calculate the Z? Yeah. Oh. Okay. Look. The look back option. This is a hard one to explain. Just assume that this is true. That the assume that V3 of HHH is 0 and V3 of HHT is 8, and so on and so forth. Then, according to the risk neutral pricing formula, which we assumed here, this one here, the X0 or V0 in this case, is equal to the risk neutral expectation of Vn over 1 plus R to the power of n. Well, in this case it's 3. It's going to be equal to the 1 plus R, which is 4/5. And then we cube that, and then it's equal to the expectation, which is going to be the sum of so this one here, it's the values of XW. So like 0, 8, 0, 6. So these are just like what the values of the V are. So V of HHH is 0. So we put a 0 there, and then the risk neutral probability is going to be 1/8 for all of them. Yeah.
So basically, this sort of scenario we're looking at, the person who has the portfolio always intends to strike at times equal to 3. He doesn't have a specific strike price in mind, or
strike price, I don't think doesn't matter.
Like they don't know the like is the idea that they will always essentially exercise the option at equals 3, or
no, they won't always exercise. They'll exercise it if they get a profit.
Yeah.
That's why sometimes. Where was it?
Here you just calculated it time 3, like the payoff.
Yeah, yeah. So, we're assuming that like it expires at time 3.
Oh, that's
so.
Expired date. Okay.
Look, I don't have the graph up here, but the reason some of them are 0 is because the option expires worthless.
Yeah,
okay.
makes sense.
So we're just sort of assuming that there, and then you plug in the values, and then you're going to get V0, which is the fair price of the option. It's going to be equal to 1.376.
You know what? I'm gonna try using this to finally calculate the fair price.
So then that's going to determine the price of setting up the cost at time zero of setting up the replicating portfolio. Then we can also rewrite this with Z. So instead of using V3, instead of using V3 with the P tilde, we can use V3 times Z times P. Okay, because we assume that Z equals P tilde over P, so we can let P tilde equals ZP. Okay, so now instead of this Z tilde, this P tilde that we had up here, we instead get ZP. Okay, so then we calculated Z before, it's those things there. We calculated the P's before, it's those things over there. So we instead, this thing, we can rewrite it as Z&P. Okay, and we get the same answer. That makes sense. So we've changed the measure from the risk neutral measure to the actual measure. Okay? Yeah.
So I get how you've done these calculations, right?
Yeah.
I'm just wondering what is the significance of these calculations? That's not like what is the question.
What's the significance? It's just because it's useful to change in some contexts, right? Like if you don't have access to P tilde, but you have access to Z and P, then you can do this kind of thing. Right?
What's the significance of calculating V?
Oh, V's V0. Yeah. Okay, so V is like so in this previous seminar thing that I keep on referencing. Yeah, that's okay. V0 is like the fair price of the option. Okay, so what we did in the first slides is like we're trying to calculate this V0, right? And we don't know how to calculate it. So it's like the fair price of an option. So an option is just like it's the right to buy or sell an asset at a particular price. So for example, like you could get, I don't know, I might have to, yeah, like gold. Yeah. So what ends up happening is that like, at first, when I just tell you this scenario about, you have the right to buy this for this many dollars, it's not clear what the fair price of the option is, right? So the idea is that we replicate the portfolio in terms of stocks and bonds with this interest rate. And then what ends up happening is that we force that into a unique price for the option. So you get all these wacky formulas with V0 in them, but V0 is essentially like V1 is like the option price at time 1. V2 is like the option price at time 2. Now, usually you know those in practice, but you don't know what the V0 is, so we have to like backtrack. Like we replicate it with respect to V1, V2, V3, then it's like, oh, if the V1s and V2s were all equal to the stock price, to the portfolio price X, then surely it will be equal to X0. Right? So yeah. Zero is the initial time. Yeah. Okay. So this is like the fair price, 1.376. Okay. So the advantage of the change of measure over the original is that the new version makes no reference to the risk neutral measure. However, it does not simply compute the expected discounted payoff of the option under the actual probability measure, but rather first weights these payoffs using the random variable Z. This leads to the idea of state prices, which we formalize in the next definition. So in an n period binomial model, let the actual probability measure P and risk neutral probability measure P tilde, that should be maths BB. Let Z denote the radon Nikodym derivative of P tilde with respect to P. So that's this thing here. The state price density random variable is z divided by 1 plus r to the power of n. Okay, because the z over 1 plus r to the n appeared here. So we want to formalize that thing because that thing's going to keep on popping up. Okay, so we call that a state price, and we denote it by zeta. Okay, so then zeta times the probability is going to be equal to the state price. Okay, so let omega bar equal to omega 1 up to omega n with a bar on top. Let that be a particular coin toss sequence in the n period model. Then consider a derivative security that pays off 1 if omega occurs and otherwise pays off 0. Okay? According to the risk neutral pricing formula, the value of this derivative security at time 0 is going to be expected. So it's like this thing here, but then it's going to equal to p tilde of the omega bar divided by 1 plus r to the n, which is equal to, well, now we know it's equal to z times p, which is just going to be equal to the state price there. Okay?
I have that question.
Yeah.
Why does the period end? Does it operate in the logic like that's the period left over until expiry?
What do you mean?
Because you said time 0, it's a Vn, which means at the end period.
Yeah.
Yeah. So does that basically mean that the period is just essentially the time left over between expiry and it? Because I thought the period went the other way, like each unit of time that elapsed.
Well, this is just saying that it ends at n.
Oh, I meant the below one.
This one.
Yeah.
Yeah.
You said it's for at time 0, so is it Vn or V? No.
Oh no, because this value thing here is equal to v0, right? Because of this formula up here.
Oh, okay. Yeah.
Yeah. We're just assuming these formulas. Lots of stuff we're assuming. Okay. So we see that the state price, zeta p, tells us that the price at time 0 of a contract that pays 1 at time n, if and only if bar of omega occurs. This price should then include a discount from time n to time 0 to account for the time value of money, and the term 1 plus r to the power of n does indeed appear in the definition of a state price. It's natural to expect that the price will take into account the probability that omega will occur, and therefore we have arranged the formula so that p of omega bar is one of the factors in the state price. However, these two factors cannot tell us the whole story because they don't account for risk. Okay? If we were to use these terms alone and take the time 0 price of a derivative security to be the expected value of Vn divided by 1 plus r to the n, then the time 0 price of an asset would depend only on its expected return under the actual probability measure. In fact, the price of an asset depends on both its expected return and the risk it presents. The remaining term appears in the state price corresponding to bar omega. For example, in the radon-Nikodym derivative, in the example above, we see that Z discounts the importance of stock price paths that end above the initial stock price S0 equals 4, because Z, when Z is less than 1, whenever there are 2 or 3 heads in 3 coin tosses, but Z inflates the importance of the stock price paths that end below the initial stock price. The effect of this is to make holding the stock appear less favorable than one would infer from simply computing this value here, discounted expected value at time. Okay. So the state price tells us if the time 0 tells us the time 0 price of a contract that pays 1 at time n, if and only if bar omega occurs. State price density tells us the time 0 price of this contract per unit of actual probability. For this reason, we call it a density. Okay. Most contracts make payoffs for several different values of omega, and these payoffs are not all necessarily one. Such a contract can be regarded as a portfolio if simple contracts, each of which pays off one, if and only if some particular omega occurs, and their prices can be computed by summing up the prices of these components. To see this, recall from Vn equals expected value of, well, tilde expected value of Vn, V capital N divided by 1 plus R to the power of capital N minus N, given Fn. The risk neutral pricing formula V0 equals that thing there, which is on the board as well. The time zero price of an arbitrary derivative paying Vn at time n. In terms of the state price density, this can simply be written as this, okay? Because we've changed from the tilde to the actual measure, and then we've introduced this zeta. Okay, so we can swap over. This equation where we rewrite in terms of z is a special case of this, where the zeta term is separated into its factors 1 over 1 plus r to the 3 and z. Okay. Now, radon-Nicodim derivative process. So in the previous section, we considered the radon-Nicodim derivative of the risk-neutral probability measure with respect to the actual probability measure in an n-period binomial model. This random variable z depends on the n coin tosses in the model. To get related random variables that depend on fewer coin tosses, we can estimate z based on the information at time little n less than n. This procedure of estimation will occur in other contexts as well. Thus, we require a general result that doesn't need z, and that's the radon-Nicodim derivative. Okay. So let z be a random variable in an n-period binomial model. Find zn equal to the expectation with the actual probability. So the actual probability measure of z given fn. So that's the information up until n. Then Zn is equal to, with n 0 up to n, is a martingale. Okay. Although the theorem is stated for the probability measure p, you can also prove it for the risk-neutral probability measure p tilde. When successive estimates of a random variable are made, price estimates become more precise with increasing time and with increasing information. However, this theorem says that they have no tendency to rise and fall if a later estimate were on average higher than an earlier estimate. This tendency to rise would have already been incorporated into the earlier estimate. This is similar to the situation with an efficient stock market. Stock were known to outperform other stocks, having the same level of risk. This would in fact have already been incorporated into the current price of the stock, and thereby raise it to the point where the superior performance was no longer possible. So, consider the 3-period model. We already determined the radon-Nicodim. So yeah, we already determined the radon-Nicodim derivative of p tilde with respect to p to be given by 3.1.5. Where? 3.1.5. Well, it was somewhere there. We defined Zn equals expectation of z given Fn. In particular, Z3 of omega 1, omega 2, omega 3 is equal to z of omega, omega 2, omega 3 for all omegas. We then compute this, which is the Z2. So that's just going to be the actual probability P plus the actual probability Q of the weighted Z3s. We can then do that again. So this is like the same way we calculate the V0, right? We have these Z3 values, then we find the Z2 values. And after finding the Z2 values, we work our way backwards. We find the Z1 values, and then after that, we calculate, it's just the expectation, right? And then we compute Z0. And then this is going to be equal to 1. Okay? So the process is shown in the following figure. It's this thing here. So if you want to look through the slides, it's just maybe you can look at this first before looking at the example, because I use these values in there. But we calculated these in the end before. Okay? So, a definition. In an n-period binomial model, let the actual probability measure P be that, and let the risk-neutral probability measure be P tilde, and assume that both of them are positive for every sequence of coin tosses. Define the radon Nicotin derivative as Z omega, like we did before. Then the radon Nicotin derivative process is Zn equals the expectation of Z given the information up until n. Okay, in particular, Zn, okay, Z capital N equals Z, and Z0 equals 1. In the context of this definition, we can compute the risk-neutral expectation of a random variable y by computing under the actual probability measure the expectation zy. Y only depends on the first n coin tosses. This can be simplified even further. Assume the conditions on the definition on page 30. That's that one there. Let n be a positive integer between 0 and capital N, and let y be a random variable depending only on the first small n coin tosses. Then the risk-neutral expectation of y is equal to Zn times y. Okay. An application of this lemma occurs if we fix a series of coin tosses and then define 1 if the omega equals omega bar and 0 otherwise. So in other words, y is going to take the value 1. The first n coin tosses result in a particular sequence. Then the coin tosses, the rest of them are irrelevant. Then the risk-neutral expectation of y is equal to the risk-neutral probability of the first n coin tosses resulting in that particular sequence, which is just going to be the p to the power of the number of heads in that sequence times q times the risk-neutral q to the power of the number of tails in that sequence. On the other hand, the expectation of yz is equal to Zn with the omega bars multiplied by the actual probability of the first n coin tosses resulting in that particular sequence. Again, it's just the p tilde to the power of the number of heads and the q tilde to the power of the number of tails. This lemma asserts that these two quantities are equal, and so that Zn of bar n's is equal to this result here. Okay, so the ratio of the, sort of like this, it's like the ratio of the probability, the risk-neutral probability divided by the actual probability to the power of the heads, the number of heads, and the same for the tails. Okay. This can be verified in the figure above, this one here. So you can have a look at that. So for example, we have, if we plug in 2 and 0 there, it's going to be 1/2 on 2 on 3, or to the power of 2, which is 9 on 16. It also happens for Z3 HT2. Plug in 1 and 2 there. We get 27 on 16. See that for each n, Zn multiplied by, so Zn of omega is the ratio of the risk-neutral probability and the actual probability of attaining the sequence of coin tosses. The lemma asserts that if y only depends on the first n coin tosses, then we do not need to consider the coin tosses after time n. We may use Zn as a surrogate for the radon Nicotin derivative Z in the formula, third property of that theorem. And Zn is computed just like Z, except that Zn is a ratio of probabilities for the first n coin tosses rather than all of them. Okay, so this is a simplified version where it just depends on the first n coin tosses instead of every single one of them. Okay. In addition to relating expectations under the two probability measures, we want to have a formula relating conditional expectations under these measures. This is provided by the following lemma. Assume the conditions of the definition on page 30. Let n less than or equal to n be positive integers between 0 and n, and let y be a random variable depending on only the first m coin tosses. Then this theorem will hold true. So the risk neutral expectation of y, given the information up until n, is equal to 1 divided by z capital N, with the multiplied by the actual expectation of Zn times y divided given the information up until n. And another theorem, consider an n-period binomial model with 0 less than d less than 1 plus r less than u. Assume that the actual probability for head, p, and the actual probability for tail, q, are positive. The risk-neutral probabilities for heads and tails are given, as usual, by those results there, which I also put on the board. These are both positive as well. Okay. Let z be the radon-nicotin derivative of p tilde with respect to p, and let Zn be the radon-nicotin derivative process. Consider a derivative security V capital N, which can depend on all n coin tosses, and the price of this derivative at time small n is going to be this big thing here, which is basically, it just ends up being 1 divided by the state price density process zeta n multiplied by the expectation of the zeta capital N and V capital N, given the information up until n, and the state price density process is defined by that thing there. Okay, so zeta n is equal to Zn divided by 1 plus r to the n. Okay. Okay, now we move on to capital asset pricing model. So I think we'll pause here for a little break and we'll come back.
Yeah, I understand what you're saying. I'm looking at your slides. I understand what's going on. Yeah. Okay. You understand what's going on? I do think I need to go back. In terms of the actual is it finance? I understand that. What degree are you? What degree are you? Okay, yes, you know what's going on. What degree are you?
I'm doing
What math thing do you want to specialize in? All right. You do like arbitrage and stuff. That's what they. I don't know what you're saying.
Wait, in poly market?
You can't make the source. Alpha, bro. I can't even know. Alpha. Hey, maybe to run QuantSoc. I don't know. Yeah, you don't stop. Yeah.
Oh yeah, there was a guy that won like $800 betting on Trump in QuantSoc. A certain individual. He just dumped. Huh? No, there was a guy that just dumped 1K. Like I won't mention his name, but he dumped 1K and is like, yes, Trump is gonna win. And he won. Yeah. No, I thought Kamala was gonna. Because I was. Oh, yeah, but I thought there was this one guy that skewed the market, right? And he was correct. He conducted his own research. The Theo guy? No, you know the guy that bet like 50 million on Trump? Yeah. 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 All right. Anyway, back to capital asset pricing model. So capital asset pricing model is going to help us with sports betting. Okay, it's going to help us be degens. So the no arbitrage pricing methodology of this text is one of two different ways of modeling prices of assets. Okay. Is that someone's? Oh.
Sorry,
How do you determine positive EV? How do you determine it? How do you determine positive EV?
I'll tell you about it.
Okay, okay. All right. So the no arbitrage pricing methodology of this text is one of two different ways of modeling prices of assets. The other, the capital asset pricing model, is based on the balancing supply with demand among investors who have utility functions that convert units of consumption to units of satisfaction. Capital asset pricing model provides useful qualitative insights into markets, but does not yield precise quantitative results available through the no arbitrage pricing methodology. Moreover, in an idealized complete market, the no arbitrage argument is compelling. On the other hand, many markets are incomplete. Many markets are incomplete and prices cannot be determined from no arbitrage considerations alone. Utility-based models are still the only theoretical defensible way of treating such markets, although there is widespread practice of using risk-neutral pricing, even when the assets being priced cannot be replicated by trading in primitive assets. This text is about no arbitrage pricing in complete markets and the mathematical methodology that supports this point of view. Mathematical methodology, however, is broadly applicable. In this section, we show how it can be brought to bear on a problem at the heart of the capital asset pricing model, that of maximizing the expected utility obtained from investment. In no arbitrage pricing, there are two probability measures, the actual probability measure and the risk neutral measure, which we talked about over there. When pricing derivative securities, we need only consider the risk neutral measure. There are, however, two situations in which the actual probability measure becomes relevant: asset management and risk management. In asset management, one cares about the trade-off of risk and actual expected return. In risk management, one cares about the actual probability of a catastrophic event. In both of these situations, however, there is a role for the risk-neutral probability measure. For risk management, the portfolio whose risk is being assessed normally contains derivative securities whose theoretical prices under various scenarios must be computed using the risk-neutral measure. For asset management, the risk-neutral measure enters in the manner set forth in this section. Okay. So we're going to set out the capital asset pricing problem. By a utility function, we mean a non-decreasing concave function defined on the set of real numbers. This function may take the value negative infinity, but not the value infinity. Okay, so a common utility function is log x, which is normally defined for only x greater than 0, but we adopt the convention that ln x equals negative infinity for any x equals 0 or below. So this is defined for every x in R and is non-decreasing and concave. Call that a function u is concave if this is the case. So u, so it's a linear function, but it must be greater than or equal to instead of equal for every x, y in R and a between 0 and 1. Say that u is strictly concave if the inequality is strict whenever x is not equal to y. And in fact, we assume that u is strictly concave wherever it is finite. A whole class of utility functions can be obtained by choosing a number p less than 1, it's not 0, and another number c in R, defining these things here. Okay, so I'm not going to read this out, but it's this if it's x is bigger than c, 0 if p is between 0 and 1 and x equals c. It's negative infinity if p is below 0 and x equals c, and negative infinity if x is below c. For these functions, the index of absolute risk aversion minus u double dash x divided by u dash x, which is a double derivative and the derivative, is the hyperbolic function 1 minus p over x minus c. For all x greater than c, class of functions is called the hyperbolic absolute risk aversion class. And the function corresponding to p equals 0 is u0 of x is equal to log x minus c, if x is bigger than c, and minus infinity if, well, I put bigger than or equal to, it should be less than or equal to. Concavity of utility functions is assumed in order to capture the trade-off between risk and return. For example, consider a gamble which pays off 1 with probability half and 99 with probability half. The expected payoff is 50, but a risk-averse agent would prefer to have $50 than a random payoff of the gamble. Let x denote this random payoff. So for example, p, the actual probability of x equals 1, and it's equal to the actual probability of x equals 99, which is a half. For a concave utility function, we have from Jensen's inequality used upside down that the expectation of u is less than or equal to u of the expectation of x. Indeed, if u of x is equal to the log, then the expectation of the log of x is equal to 2.3, and the log of the expectation is equal to 3.91. We model agent behavior as maximization of expected utility of our payoff. The model would indicate that an agent would prefer the non-random payoff expected value of x equals 50 over the random payoff x. By comparing expected utility of payoffs rather than expected payoffs and choosing the utility function judiciously, we can capture an investor's attitude towards the trade-off between risk and return. Let us consider an n-period binomial model with the usual parameters: 0 is less than d is less than 1 plus r is less than u. An agent begins with an initial wealth x0 and wishes to invest in the stock and money market account so as to maximize the expected utility of his wealth at time n. In other words, the agent has a utility function u and wishes to solve the following problem. Given x0, find an adapted portfolio, process delta 0, delta 1, so on and so forth, up until delta n minus 1, subject to the wealth equation xn plus 1 equals delta n multiplied by s n plus 1 plus 1 plus r multiplied by xn minus delta n sn. Okay, so yeah. Yeah, but they're like based, it's like it's verbatim from a book. So look, like if this gets uploaded onto YouTube, it might get like, copyright strike and stuff like that. So we have to maximize this subject to xn plus 1 equals delta n sn plus 1. Mhm. Right. So this thing is like the problem in the first slides. Right, again. It's like, so delta is like the number of stocks we own. Delta is the number of stocks we own at a particular time. So in this case, n. S is the stock price at time n plus 1. 1 plus r and this thing. So the thing that we were doing in the first slides, that we had a combination of stocks and bonds. Okay, so we have like xn is our time n wealth. Like xn is like the money in our bank account. Yeah, we need to borrow some money to get stocks. So we get Sn and we get this many stocks. Yeah, but we borrowed this stuff from bonds. So we need to pay back the interest rate R. Yeah? So that's like from the bonds. And then we have our amount of stock at time n plus 1 is now n plus 1.
So is
Yeah.
that second expression, like the 1 plus r times xn minus delta n?
Yeah, this.
Is that negative?
Usually, yeah.
It's usually negative.
Like it could be
You have to
positive.
pay it back.
Yeah, usually, yeah. So it's like this thing we're paying back, and then this thing is this, and then basically we do this the whole way through. Then we're like, okay, how do we trace back our steps through recursion to x0?
The value.
Yeah. 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 Does that make sense? Yeah. And then basically the goal there was to try to replicate such that it's like exactly the same as owning the option. Well, it's subject to this. It's like we have to maximize this thing given that this thing is true. Okay. You know Lagrange operators? Yeah. Okay. Good. All right. See ya. Yep. Okay, I'll show you how to do that. So note that the expectation here is computed using the actual probability measure P. The agent is risk averse and uses his utility function U to capture the trade-off between actual risk and actual return. It does not make sense to do this under a risk-neutral measure because under the risk-neutral measure, both stock and the money market account have the same rate of return. An agent seeking to maximize the expected value tilde would invest only in the money market. So here's a two-period model. Consider the two-period model in which the interest rate R equals quarter. So the risk-neutral probability is just going to be all a quarter. Assume that the actual probability measure is this, 4, 9, 4 over 9, 2 over 9, 2 over 9, and 1 over 9. Then we just sort of do maths here. Consider an agent who begins with initial wealth 4, so that's $4 in the bank account, and wants to choose the amount of stock to hold at time 0, the amount of stock to hold at time 1 when it goes up, and the amount of stock to hold at time 1 when it goes down, in order to maximize that value there. So the expected value of the log of x2. Note that x1h is equal to this thing here, x1t is equal to that thing there, and the x2s are equal to all of those things there. Okay, just have to like brute force them. Okay.
That's just the bulk equation, right?
Yeah. Yeah. So you just like calculate that.
Yeah.
Then what ends up happening is you plug them back in, and then you get. Yeah. So this is from. So this is like the expectation of log x2. So we assume that. So like these probabilities are already there. Yeah, the actual probabilities. And then like we have the x2s, we have the x1s. And now we calculate this. So we just plug them in. Yeah. Yeah. Then the sort of optimizing here, this isn't exactly Lagrange stuff yet, but we take the partial derivatives with respect to delta 0, delta 1, delta 1, h and t. You know what partial derivatives are? Yeah, okay, so partial derivative is like.
Is it like considering like one variable?
Yeah, so if you have like a bunch of stuff. Yeah. So if you have like a. Yeah, if you have like this and then you want to find derivative of x, you hold y as a constant and then you differentiate with respect to it, and it's just y. Yeah. Yeah, that's it.
Derivative, right?
Huh?
That would be y plus y times x.
What do you mean the actual derivative? What do you mean?
I differentiate the whole thing then xy with respect to x, and I use the product rule, and I get y plus xy dash as an x times dy dx.
What if you just steamroll it like implicit? You don't need to do that here.
Yeah, I know.
Yeah.
So like partial derivative.
you can try to implicitly differentiate things, but we don't need to here. So basically, if you differentiate it with respect to delta 0, you get this thing. If you differentiate it with respect to delta 1h, you get this. If you differentiate it with respect to delta 1 of t, you get that. Okay, so then you set these derivatives equal to 0, because that's how you maximize things, and you obtain these 3 equations here. Then we rearrange the last 2 equations to cross multiply, and then we get x2hh plus 2x plus 2x to ht, and then this one down there. You can substitute these 2 things in the first equation, and then we get x2 of ht equals 2 multiplied by x2 tt. Okay, and then this gives us 3 linear equations in 4 unknowns. What we're going to do is we're going to use the corollary from the second chapter, so this one up here. And then what we're going to get is we're going to get a 4th thing. So 4, which is the initial wealth we started off with, multiplied by 16 on 25, and then the expectation. So that's just that thing there. So then we have 4 equations now. Solving these 4 equations, we get these 4 numbers. Okay? So you just have to brute force it. Then we can now find the values of delta 1h, delta 1t, and x1, the x1 and the delta 0. So this equation introduces the risk-neutral measure to the solution of the optimal investment problem, even though the actual probability measure appears in the statement of the problem. This suggests that we might replace our first problem by the following problem. Okay, so instead of maximizing this with respect to the wealth equation, we can instead do it subject to x and 1 plus r and equal to x0. Okay, this is a new optimal investment problem, and it's because of this thing here. Okay, so we've introduced this new one. So this thing should yield the same thing as before. This might be slightly easier, so how do we do this? Okay, so here's the new problem. You have to maximize the expected value of the utility of xn subject to this. Okay, how do we do this? So suppose that the little star at the top basically means it's the optimal version of it. So assume that's an optimal portfolio process for the first problem, and xn star on top is the corresponding optimal wealth random variable at time n. Then xn with the little asterisk on top is optimal for our second problem as well. Conversely, suppose that xn is optimal for our second problem, then there is a portfolio process that starts with initial wealth x and has value xn star on top at time n, and this portfolio process is optimal for our first problem. So the lemma separates the optimal investment problem into 2 steps. First, we find a random variable xn that solves the second problem, and secondly, we construct the portfolio that starts with x0 and replicates xn. So the second step of the algorithm uses a theorem from chapter 1, which is this one down here. Okay? So just assume that formula too. Okay? So we'll continue with the example in the new context. So first, the rate on Nicodim derivative, p tilde with respect to p is this stuff here. Okay. Then simplifying matters, we find zeta, where we just divide by 1 plus r on 2, which is going to be equal to these equations here. In addition to this, we'll denote x1 as x2hh, x2 as x2ht, and so on and so forth. We'll also denote p1 as the actual probability of hh, p2 is the actual probability of ht, and so on and so forth. Then these notations, we can reformulate the second problem. where we find a vector x1, x2, x3, x4 that maximizes the sum of the p1 multiplied by u of x1 subject to this restraint here. Okay. So in our case, we must find a vector that maximizes this subject to this long equation down there. Okay, just basically this thing here, but with the numbers. So Lagrange multipliers. You know Lagrange multipliers? Yeah?
Oh, I know it for like just two variables.
Two variables. Okay. Do you know Lagrange? No? Okay. Lucky I wrote it down here. So, huh?
Good shit.
Yeah.
I'll tell you write it down and figure it out.
Okay, so basically, like,
Just get recording and uploading to YouTube. That's it.
Lagrange.
It's not.
Okay, so let's find an optimal point. So to find optimal of f of x1, x2, up to xn, given g. Can you see this? All right.
It's so odd.
Okay. That's
I think you also put it backwards. It's not cooking.
time to use texter. Is that better? Yeah. All right. So Lagrange. Okay, so if we have to find the optimal point, this thing, given a constraint, how do you do this? Here's how you do it. You let del of f equal to lambda times del of g. Yeah? Have you seen del before? Okay. Yes, I will. So, remember what a partial derivative is? Partial derivative, yeah? I explained it before, yeah? So basically, yeah. So a partial derivative, because it's just you hold all the other ones constant and you derive it with respect to one variable, it's like a part, yeah? It's one part of the story, but you don't get to see the whole story, yeah? Do you want to know how to see the whole story?
Yeah.
You put them all in a vector.
Okay.
So like,
I'm still hearing you.
so it's like so this is like, you know, like a vector, like there's like 1, 2, 3 things in the vector. It's like a vector full of the partial derivatives of all of them. Yeah, and then you set this thing equal to lambda times all the derivatives of g. Wait, yeah, close bracket. Yeah, which one? This? It's an upside down triangle. This? Partial derivative.
Yeah, I know it's partial derivatives, but is it like
It's a partial. It's like a,
partial derivative again?
yeah, it's like a delta, because like D is the normal one. It's not really a delta, it's like a weird delta. Okay, so then basically what happens here is like the delta, the partial derivative of f x1 is equal to this. And then you get like n equations, yeah? Up to n. So here's an example. If you have to maximize, so usually the g comes in forms of like an equation. Okay, so like if you have to maximize, so if you have to do this, yeah, like you have to maximize xy on x squared plus y squared equals 1. Here's what you do, yeah? You let g equal to squared plus y squared minus 1, which is 0, yeah? So then the g is equal to 0, like that. And then you take the partial derivative of both of these. So like the partial derivative of f with respect to x is what?
So 2x is y squared.
No, for this,
Oh, okay.
for f, y, and then the g, 2x, yeah. So then you have, in the first case, y equals this, yeah? Because you let it equal to the lambda times that, yeah? Then the second case, what do we get? Well, this is just going to be x, yeah, because like derivative of this with y equals, this is going to be the same thing but with a y, yeah? You understand what I'm doing here? Oh, this is just like, sorry, I'm skipping steps. I'm doing like a derivative of f. So this x here is because derivative of this is x, yeah?
Yeah, that is correct. Yeah.
And then the derivative, yeah, sorry. This is going to be 2y. So it's going to be like this, yeah? Yeah. And then basically like you try to solve this. So basically what we can do is we can multiply y on both sides of this. Multiply x on both sides of this. So x squared equals y squared now, yeah? And then it's like we said here, they equal to 1. So then 2x squared is equal to 1, yeah?
X equals 1 over 2.
Yeah.
Which does do the compound.
And then basically you have to fumble around and sub things in. You basically get that. I'll write it up here. So f of this is a max, and also this is max. You have to fumble around on your calculator for that, but they're maximums, okay? And both of these are equal to half. So we're using this Lagrange multiplier method on this thing now. So for this problem, it's going to be this equation here. So this is the f, this is the g. Yeah. Yeah, you can. Yeah. Yeah, it's like the same thing. Yeah. That's going to be the Lagrange. Then you have the multipliers. So the derivative of x1, x2, x3, x4 is equal to this thing with the lambda all equal to 0. And this implies that x1 is equal to 25 on 9 over the lambda. Sorry, 25 divided by 9 lambda, and so on and so forth. Okay? This is just like doing the math.
You can like sub these into each other.
You can, yeah. So then substituting these equations into the slide 74, this one, what you get is this thing here is equal to 4. This means that 1 on lambda is equal to 4. And we can now conclude the optimal wealth at time 2 is equal to this thing here. So x1 is equal to 100 on 9, x2 is equal to 50 on 9, x3 is equal to 50 on 9, and x4 is equal to 25 on 9. Okay? This agrees with what we got in our other version. You can now proceed to calculate delta 1h, delta 1t, and delta 0 as we did before. If you want the computations, you can check the slides before. We got things, these things here. Yeah. Okay. So in general, the solution of the second problem follows along the lines of the previous example. It's complicated by the fact that both the actual and risk mutual probability measure appears in the problem formulation. Consequently, we introduce the radon-Nikodym derivative Z, P tilde with respect to P, and rewrite the risk mutual expectation without reference to the risk mutual measure. This constraint becomes the expectation of Zn xn divided by 1 plus r to the power of big N is equal to x0. So we can take this one step further by recalling the state price density Z on 1 plus r to the n, in terms of which the risk mutual expectation of xn to the 1 plus r to the n can be written as the expectation of zeta xn equals x0. In an n period binomial model, there are capital M equals 2 to the power of capital N possible coin toss sequences. We can list them out like this. We use superscripts to indicate that it's a full sequence of coin tosses, not just the mth coin toss. Let us define zeta m to be equal to zeta of omega to the m, pm to be equal to the actual probability of omega to the m, and xm to be xn of x capital N of omega to the m. Our second formulation of the optimal investment problem can be reformulated as follows. So here's another thing we can do. I'll rub this off. So given XO, find Okay, so basically you have to subject this to this, okay? So it condenses into yet another optimal investment problem. This is like the general form of it. So the Lagrangian for this problem is going to be L equals sum of the PM UXM minus the lambda of this, okay? The Lagrange multipliers are going to be in this form. They're going to be all set to 0. Yeah. Which is usually log. This is in general. These equations reduce to the derivative of u of xm is equal to lambda of lambda times zeta m. Calling that xm is equal to this thing and zeta m is equal to this thing, we can rewrite this as u dash of xn equals lambda z divided by 1 plus r n to the n. So at this point, we need to invert the function u dash. Since u is strictly concave everywhere, it is finite. Its derivative is decreasing, and so it has an inverse function, which we will call I. For example, if u x equals log of x, then u dash is equal to 1 on x. Setting y equals u dash of x equal to 1 on x, we solve for x equals 1 on y, and this determines the inverse function. Okay, so that's very simple there. You just get 1 on y again. After determining the inverse function, we invert u, or we invert u dash to receive I of lambda z divided by 1 plus r to the n. This gives a formula for the optimal xn in terms of the multiplier lambda. We solve for the multiplier lambda by substituting xn into this equation here, and then we get this. Then after solving this equation, for lambda, we substitute lambda into xn, the inverse function, to obtain what xn is. Then we use the algorithm presented before, which is in the first slide, which is this thing there, to find each of the deltas. So a step-by-step way to do this is to first solve for the expected value, this thing here for lambda, then compute xn by subbing lambda back into this, and use the xn in the algorithm of the deltas to find each of the deltas and each of the xn's, x1, x2, up to xn. So a summary, this chapter details the methodology for changing from the actual probability measure to the risk-neutral probability measure in a binomial model, and more generally, the methodology for changing one probability measure to another in a finite probability model. The key quantity is the radon-nitrogen derivative, which is just p tilde divided by p, which is a finite probability model, which in a finite probability model is just the quotient of the two probability measures. The radon-nitrogen derivative is a strictly positive random variable with the expected value of z being equal to 1. The expectations of a random variable y under the two probability measures are related by the formula tilde expected value of tilde y. Sorry, the tilde expected value of y is equal to the expected value of zy. In the binomial model with actual probabilities p and q, the risk-neutral probabilities p tilde and q tilde for heads and tails respectively, in addition to the radon-nitrogen derivative random variable, is z equals this thing. It's just the ratio of p tilde and p to the power of the number of heads in the sequence, and the same thing for the tails. Then we have a radon-nitrogen derivative process, Zn equals the expected value of z given Fn. This process is also given by this formula here. Now the word Zn is the ratio of risk-neutral probability of partial paths of n tosses to the actual probability of the same partial path. And the random variable y depends only on the first n tosses, where n is between 0 and n. It takes the simpler form, expected value of the risk-neutral expected value of y is equal to the expected value of Zn y. This shows that when y is determined by the outcome of the first n coin tosses, then we need only consider the ratio of the risk-neutral probability to the actual probability for these n tosses in order to relate p and tilde p expectations of y. Conditional expectations under p tilde and p are related as follows. Y depends only on the first m coin tosses, and m is between 0 and n, which is between 0 and n, then this formula is true. So the risk-neutral expectation of y given n is equal to 1 over Zn multiplied by the expected value of Zm multiplied by y given the information up until n. In computing the conditional expectation, we imagine that we have seen the coin tosses up to m, and we have assumed that y does not depend on coin tosses n plus 1, so on. The coin tosses n plus 1 up to m, which we have not seen and affect the value of y, have a risk-neutral probability of the p tilde to the power of the number of heads multiplied by q tilde to the power of the number of tails. And the same thing for the actual probabilities. The ratio of these two probabilities is this. Okay, so that's where the thing comes from, that ratio. Thus, this quotient random variable is used to write the tilde p conditional expectations in terms of the p conditional expectation. Note in this regard that the right hand side of formula up there may be written as that. So this one can be written as the expectation of Zm divided by Zn times y, since Zn depends on only the first n coin tosses. The rate on Nikodym derivative random variable Z in the binomial model gives rise to the state price density, which is that value there. We may interpret the zeta function, the value at time 0 per unit of actual probability of a derivative security that pays 1 at time n if the coin toss in results in the sequence omega. We can use the state price density to solve the following optimal investment problem. Given the expectation of the utility function of xn, subject to the wealth equation, that one there, try to maximize that. What ends up happening is that we instead want to maximize PM of the utility function of xn subject to the sum of these values here. Okay, and that's going to be equal to the initial wealth. So in the first problem, the search is all over the portfolio processes, whereas in the new problem, the search is over the m variables. Second problem is simpler and can be solved by the method of Lagrange multipliers. The optimal values of xm satisfy this equation here, where lambda is the Lagrange multiplier. This leads to the inverse formula, xn equals I of lambda z divided by 1 plus r to the n. So I is the inverse function of the strictly decreasing function u dash, and the Lagrange multiplier is chosen such that this condition holds. Once the optimal terminal wealth, xn, is determined by these equations, we treat it as if there were a payoff of a derivative security and determine the portfolio process which solves the first problem as a hedge for the short position in this derivative security, using the algorithm of theorem 1.22, which is this one here. Okay. References before we get a copyright strike. This is from Shreve's 2005 book, Stochastic Calculus for Finance 1, Binomial Asset Pricing Model, specifically Chapter 3. Okay. And thank you for coming.